After a really strong finish to the week last week, stocks continued to push up higher today until about midday, and then things really took a turn. And we're going to talk about that turn and talk about today's late drop. A pretty singular decline in terms of percentage moves after such a strong start. So we're going to talk about what that means, where we've seen that before, and what it means from a market posture perspective. Have we changed our tune now? Are we now beginning this pullback that we've been anticipating, that we haven't had anything more than just noise in terms of the downside? Are we going to have more of a sustained drop, and do we want that or not? So I'm going to break all that down in today's video. We're also going to take a look at a stock in an industry that had a really good run for a while, but has been stalling out and may provide us an opportunity for kind of a hedge type trade to the broader market as a whole. So let's go ahead and get started. Today is Monday, July the 13th, 2020. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see change today, how we ended with the intermediate line turning back down and back down below the market sentiment line. So after a brief little jump up, dropping a little bit back down here, still you can see as big as decline that we had today, down nearly 1%. We still stayed up above the 78% level that we cleared last Monday, and spent all week going up and down through that through that here until today. And we started up today, and before finishing back down with an oversold momentum line, and of course the near-term line turning down, still above 50 though. You take a look at how the response here, first of all, long upper shadow on the Dow Jones Industrial Average, but it's in dark pink territory and close to, at the best, getting a yellow line, if not a red line here. Intermediate line well below the market sentiment line. The near-term line, however, not dropping yet, so it's actually still a little bit higher. The NASDAQ was the biggest loser, and after getting this overbought cluster on Friday, that's a pretty significant engulfing pattern today. But you notice here that we do have a bullish intermediate confirmation signal. So you have a strongly overbought intermediate line, which is bullish, strongly bullish, still above its market sentiment line as well, despite today's drop. You have a oversold momentum line. It didn't quite get to extreme levels, getting below the 5th percentile of the extreme lows there. Came pretty darn close, however. And then the near-term line also coming pretty darn close to dropping below the midpoint of the chart. So that right there is a bullish intermediate confirmation signal that can produce really short-term buy signals. This isn't like here we go, this is a buy the dip that we're going to rally now for the next 3 months. No, it'd be more like, a couple of days. It's that short-term of a signal, but it is a bullish signal nonetheless. And then finally you look at the Russell 2000, and we continue to have dark pink shading. The near-term line doesn't look like it's anywhere close to getting up above the market sentiment line, much less the upper reversal zone to signify a bullish pattern. And we do have a yellow line because it's slowly rising, but not looking nearly as good. So between the Russell and the Dow, you've got some bearish patterns there, and then the S&P 500 dropping back below the market sentiment after, it's kind of like this, where you dip a toe below it and you just come right back up above. We make another leg higher. Well, this would be getting up above it, dipping its toe up above it potentially, and dropping back down. So definitely something to keep an eye on, especially if we were to break through like this 31.40 level and stay down there, of course. It's one thing to break through it on an intraday basis. It's another thing to break down and stay down. Of course, when you look at the weekly chart, that was what was so significant with the, and we're only one day into this week, of course. But you can kind of see, again, this puts into context the type of move that today was. I mean, it was significant. Got a lot of people a little up in arms. But in context, here, especially on the NASDAQ composite, which also showed a cluster on the weekly chart, you get a little bit of a dark cloud cover there. And it's got more room to drop to kind of maintain this noisy pattern of dropping it, at the least down to the 23% line. And again, you can see strong bullish posture, and near-term line still well above, and has been. This, we've had how many let's see here, one, not this one, one, yeah, that one got above 50. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. This would be number 16 periods, because so it would be a week of the near-term line up above, and you kind of get an idea of how long these can last by looking back in the past here. And especially when you're starting new intermediate runs, you can get in this case you had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, and then 20 by the time it dropped back down. And that was on the initial rally in early part of 2019, similar to what we got here. So we'll see if that ends up playing out again, something very similar to that. You can see here we never did get a drop, a significant drop in the momentum line until we had this come down. But if you look at some of these other patterns, again, 16 periods is a long period. In fact, if I go out a little bit longer to when this one started, we did have enough of a drop here, and that kind of broke it up a little bit coming off of that period. And then you had a pretty decent long run, especially here in 2000. At the end of 2017, early part of 2018, we went weeks without the near-term line dropping below 50. So we've seen this kind of pattern before, and as I mentioned, in 1998, we saw a cluster like this being this far above the moving average. In and of itself, it would be really bullish, or really overbought, excuse me. But considering that we've seen this before, I wouldn't necessarily automatically mean that we're dropping. Today, even with today included, it was one down day, but we can drop from 0 to 23% in no time, for no reason, right, other than just noise. So obviously there's going to be some reasons out there that are promoted, that are pushed from a headline perspective, but the reality is you can go from 0 to 23% easily without a catalyst. And we are still not even halfway through that mark. Before we look at some other charts here, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us here on YouTube. That notifies you when these videos are posted. Also, while you're down there, click that thumbs up icon. That lets us know two things. You liked our video, number one, and number two, that you want us to do another video again tomorrow. If that's the case, let us know with one click. You can do that right now. If you don't like our videos, of course, you don't have to click on anything. And also comment down below. What did you get out of our videos? What questions or comments do you have about anything I talk about? Post that in the comment section below. Join our website at marketscholars.com. There's a link popping up right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow us on Twitter for more content in between the videos from day to day. And join our Market Outlook Facebook group that we've created. Alright, if you're watching us on our blog here, check out our Market Outlook live videos that we do. I do one of these every day. I do the Market Outlook. We review all of our old trade ideas. All of our monthly subscribers get access to these videos, so check that out as well. Our monthly subscribers also get access to all of our trading rooms, all 8 that we do every week, as well as all the recordings of the trading rooms that we've done in the past. You get our calendar with more classes up right there you can click on. Also, engage with us here on social media. Click that heart. It opens up this window. Hit that like button right there. Hit the thumbs up icon. That takes you to your Facebook page. Hit that like button as well. Again, the more you do those things, the more it benefits us, because Twitter and Facebook will promote our content to all of our followers, content that has a lot of likes and engagements and retweets and all that. Also benefits you because they'll promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. Alright, heading back over to the weekly charts here. Again, this puts into context today's move. You still have rising momentum. You still have a higher high on the weekly Hakinyashi. You do have a higher low. The open here, the low point at 31.16, we're trading at 31.55. So it still has to be pretty bearish for us to even get a lower shadow, much less turn into a bearish candle. And so again, no lower shadow, higher high, and a higher close so far, one day into the week. Again, puts today's move in a little bit of context, and especially with the positive momentum. You take a look at the Dow, and the Dow is finally holding above the 200-day moving average. This is what it looks like on this chart. So that's a positive development. There's your NASDAQ, and there's the reason why, even with today's move there, you can still see how bullish that candle is. The open there at 10,318, and we're at 10,600. So a few hundred more points, and the PPO as high as it is. It's about as strongly bullish as we've been on this since 1999 on the Nasdaq 100. So there's a reason to be there's a reason to recognize that as a risk factor. I wouldn't necessarily short the Nasdaq or short the stocks or be bearish, but it's definitely something to keep an eye on in terms of like, okay, this is the leadership, and I do have to acknowledge the fact how overbought it is with how I manage my risk. Do I load up on this one side? Do I load up all in these types of stocks? And how do I diversify and manage the risk that this is causing? This and acknowledge this particular risk factor, because it is pretty high. But on the other end of things, you can see like the Russell 2000 still is not clearing that 200-day moving average, and you can see it's flirting with that 23% line itself of potentially rolling back down below it and starting its own pullback. Right, it's flirted with getting below the 23%, always bouncing right back up above. This time you get below the 23%, you have a good chance of getting back below the 50-day moving average as well. So we'll just kind of keep our eyes peeled on that. Nothing today hasn't changed the trend yet, hardly at all. Especially when you still have 3 green arrows, and for that matter, you're also still, as you can see here, up above the 8-day moving average. Now the stochastics cross both moving average, but they're both above 80. The MACD histogram is coming down, but it's still above its moving average. And like I said, they're still above the 8-day moving average, and especially above the 8-day moving average on the NASDAQ, right? So that's how bullish it is. And then you look at like the IWM, and this is the concern here, is that it did, it's been kind of flirting with that 8-day moving average, up and down, up and down, up and down. Yes, Friday getting back up to it, today getting back down below it. With both those lines below, the MACD negative, the moving average of the MACD close to being negative, and the stochastics dropping back down. So, we'll kind of keep our eyes on the weakness that IWM is showing and suggesting that we might get in the broader market. You can see it's below 50, but it's still neutral. It's not really bullish, but it's not really bearish either. But you look at the QQQ, and it had been strongly bullish, and you notice it's actually still above 60. So, again, that puts into context this move. Like, we could drop to 23%, and that would be considered a pretty significant move, but it wouldn't be considered a pullback because of how big this rally has been. You don't pull back some start, remember, until you break the 23% line. Keep that in mind there. You take a look at the Bollinger Bands, and again, to kind of give you an idea of the Qs, we were pretty high. Like that, the 23% line is also going to act as support because there's a volume node there, and of course there's a bigger one down below where the 38% level is down in here, and of course where the 100% mark of this old high point. So there's going to be some support. Interestingly enough, as big of a drop as that was, we still stayed in the upper quartile of the Bollinger Band width. So whether we do tomorrow or not, but this kind of shows again how bullish we were, because that still didn't even get us into the neutral range of the Bollinger Bands. And then finally looking at the DMI and looking at it for QQQ here. Again, we're not above 40 yet on the positive index, and the negative index isn't below 20 or 10. So you have your ADX up above 25, but once it gets above 30 and up towards 40, that's when you start to say, oh, that's a little too high. I mean, look, over here you got a cluster on the QQQs. You had a really high positive index, and negative index wasn't so low. We were just barely crossing 25 on the ADX, so we are just barely turning dark green here. You can see tomorrow is going to be the first day we turn dark green on the QQQ. So just because we're this bullish, and this is not a log scale, mind you. Here, let me change this. So there's our log scale now. Just because we're this bullish, you can see we maintain bullishness all the way up to, for about another month and a half. going into obviously this significant pullback, and no one's expecting that type of pullback to reoccur, hardly at all. All right, now let's take a look at the intraday chart, and there's your SPY filling in the gap from this morning, and that makes sense. QQQ also filled in its gap from this morning and continued lower. It still hasn't filled in that gap, and this is the move, right? This is the concern. If we break this kind of 257 area, there's not much volume until you get down to 244. I mean, we can really drop pretty and start filling in gaps along the way and really kind of drop here. And again, that would get you down to the 23% line. But for SPY, that would get you more. Here's where SPY's 23% level is. It's way down here at the bottom of the 4-week range. We'd have to, you'd have to basically break this 312 area for us to say okay. And then there's in fact, if I were to activate this drawing now, this is the current near-term run and get up to this area. There's your 23% drop that we have now broken down below. So your support level at 38% retracement is also where our volume node is. So breaking below 313 essentially would say, you'd be saying, okay, we have a good chance of filling in this volume gap, which is even more pronounced on the Qs. Let's take a look here at today's trading range and volume. Volume picked up 100 million shares. The trading range also picked up above average, 8.5 points. Remember, we filled in the gap. So let's take a look at how big those numbers are. And 8 points is right here, so it's bringing it up a little. 100 million is right there, so it's not that significant. And we're still around 2%. And the volatility index jumped up with today's loss. You can see how we made a run back up to 32.5. In fact, this is one of the bigger volatility days that we've had in a while. And every time we've had one of these bigger volatility days, even this big one here, we might have another day to follow up on that, but we generally come back down, maybe another day or two, and then we fall back down. And so the difference this go around is that the volatility on a relative basis is in the neutral zone. So again, that puts in the context how bullish this is. I mean, last time we made a run up, from these low levels up to this 30, so right here on 611 coming off that 610 area, you can see that we jumped up above 95%. So that should put a little bit of cold water on this fire that we had today with how the VIX is performing. All right, so let's pause and take a quick time out here before we look at these different markets, intermarket relationships, and our trade idea of the day. And let's review this technical outlook. So the posture is bullish, and we had a day of weakness, and you're bound to get a day of weakness, especially after like the overbought cluster we had on Friday. So you're bound to get a move like today. And there are some signs of weakness, especially in the small cap index, that suggest that we could finally get a pullback that we haven't had for a few months, which would be more than okay, right? Because it would provide us a better opportunity for a new intermediate run for here. Like if you were banking on if and when a new 1 to 3 month rally would begin, the odds of it beginning yesterday or Friday, it's not 0 or 100, nothing it ever is, but is pretty darn low. Whereas if we got a pullback towards Fibonacci support, then the odds of a new 1 to 3 month rally get really, really high because we can sustain a longer move off a more, we can exhale, and after an exhale we can breathe in for longer. So there are some signs that kind of move is coming, but today doesn't suggest in and of itself that here we go, right? In fact, there's a good chance we can just bounce right back off of this tomorrow and continue to move higher towards Friday's expiration date, for all we know, especially with earnings season starting really in earnest tomorrow. So what do you think? Do you agree with that assessment? Do you disagree? Let me know down in the comment section below, especially if you disagree. Why are you more bullish? Why are you more bearish? What charts or indicators are you using that would suggest that? And share with our community what you're using down below. All right, now let's talk about what's driving this price action, and let's take a look at the different asset classes. And you can see here, or this is a 3-month chart, why the Qs came down as much as they. I mean, you can't sustain that wide of a divergence for as long as we have. And I don't necessarily think that we'll fill in that divergence like right now. It just means that we're susceptible for these types of moves. You can see we can drop down, and when everything drops down. Now, what is a little concerning about today, and it's only one day, so we'll see if this turns into a trend or not, but it's one thing for the Qs, for IWM to outperform the Qs on up days, because sometimes there's a rotation into the trash and the junk and the small cap stocks. It's quite another for IWM to outperform the Qs on a down day. Usually lately when we've had the down days, IWM is what drops the most. So the fact that the Qs dropped the most, again, it's only one day, but if that continues to be a trend, that takes us back to this chart where, and you can see this is the relative strength of Qs to IWM, and there's the last couple of days right there, right? Let me just update it just to be sure. But yeah, there's the last couple of days. So that, again, that should put in the context what the kind of move that we just had, and not very much of a decline. We're still above 60 on the relative strength line, and when this is bullish, the markets are bullish for the most part. But if this really starts, and you can see we can come down to 1.8, and that's the old resistance. But if we really start dropping pretty dramatically here on this level, with both indexes dropping, again, this outperformance, you can see this is nothing new. I've shown you this before, but let's get to a weekly chart, and let's go back as far as we can. This outperformance of the Qs versus IWM has been going on since the market peaked in 2007. Really before the market peaked in 2007. That's when the trend of this relative strength of the Qs really started to take off. And you can see they've had some times where it's pulled back, from the beginning of 2016 to the end, from the middle of 2013 to the middle of 2014, and then you had some runs on the QQQ throughout all of 2017, throughout most of 2019, and then of course it's gone parabolic here in 2020. The PPO, the MACD especially, really taken off to a much higher level. Let me show the long-term PPO here, and you can see here, you can see how parabolic we've gone, and we're moving up significantly. So that's, this is hardly, a strong sell-off. But the more, we break back below 180, and the more this drops while the market's dropping as a whole, then that is pretty significant. That will be bearish. Because again, you would expect at some point in time, if I were to look at this, again from essentially the beginning of 2017, right here. So if I were to go back, here to the beginning of 2017, you can see the outperformance of QQQ, especially relative to IWM. IWM is right. You can see that it's down here in this brown. I'm just going to highlight it. You can see it's barely above zero. So since the beginning of 2017, IWM, which is kind of a broader, obviously broader market because it, it's small cap stocks, right? It's basically flat as a pancake. It's had some positive runs, but has gone completely flat there. Commodities down. You can see high yields struggling here this year, and emerging markets have been struggling, and they're starting to get some lift. And you can see bonds and gold still very strong. Recessions don't start with bonds and gold that overbought, but it kind of gives you an idea. But look at QQQ. Look at that outperformance versus IWM. It's insane. It's a huge number, and that's not going to recover in a year. That gap will recover at some point in time, because it does, right? When it widens out, it pulls back, and it will recover. And we saw that, again, the other time it really widened out was 1999 and the beginning of 2000, and it took 3 years, but it recovered. It recovered back down to its previous levels, and so you would expect this to do the same thing too. It just won't happen overnight, and I don't necessarily think it will start happening now. But it should, like when you see a day like today, we say, okay, that's the kind of move I'm a little worried about. Let's see if it lasts more than just one day, because literally This is like the first day, anecdotally, that I can remember that we've had a pretty down day, and the Qs were the leaders to the downside. It's usually been that small cap stocks that have been leading. In fact, if you look at the Market Watch tab here and look at the quotes, and you can see, I mean, you have Las Vegas Sands, Wynn Resorts, you have Pfizer, you have Deere, you have a bunch of different sectors leading us up to the upside. This isn't like a trash day. But then you look at the downside movers, and it's all information technology, right? All information, a little bit of consumer discretionary, communication services, all really big and down day today too. So it was a the more days we get like this, then we're like, okay, we are pulling back here, and the Qs have a lot of room to pull back. The Russell 2000 doesn't. So the Russell 2000 is already in bear market mode, right? Or excuse me, death cross mode. If we pull back down below the 50 and we really get going to the downside, then that's essentially bear market now, because we've been in death cross mode for a few months, and you would expect if we break below the 50 that we'd be in it for another few months. So again, I don't expect that to happen, but that's what would happen if we get more days like today to follow through here. Let's take a look at a sector, and this is kind of interesting to see how the sectors perform today. You can obviously, there's your QQQ, right? XLK, XLY, XLC, they've been the biggest winners. Energy had been doing pretty decently. Industrials have been doing pretty decently here for a while. Materials is there, but they're now all lagging the market. And there was this post, I tweeted this out, this article here, and this article basically reinforces what I've told you before about how a lot of the returns, especially since the 2018 peak in January, most of the returns have come from technology and discretionary. We didn't have XOC at the very beginning of that year, so that's why you don't see it showing up, but it would be up here too. And you can see the only other sectors that have outperformed the S&P are utilities and then healthcare, and real estate barely coming in underperforming. Everything else, look how negative all the rest of these sectors, industrials, financials, materials, energy, staples, barely positive. Again, this is over 2 years of returns since January of 2016 or 18. So most of the returns are coming from, and XOK is by far the biggest sector in the S&P. So most of that 13% return is coming from that 60% return in XOK. And that's just the reality of the market environment that we're in. That has continued to be the case over the last 3 months, as you can see. Real estate and utilities are down. That's pretty typical. But you see financials are down with them. And now energy is down with them. And healthcare has been lagging behind. And industrials is only up 8% versus a 13% return for the S&P. So then you look at, okay, well, how did things perform here today? Just here today, and it was kind of interesting because at the beginning of the day, healthcare did really well. That's what was a lot of the positive news. Discretionary, industrials rallied, financials rallied. So it was kind of these sectors that have been underperformers, they did really well. And by the end of it, but you can see technology is kind of matching the market, and discretionary is obviously one of the better performers. And then you can see communication services, small lag. But then right about here at about 10:30 Eastern, so 12:30 Eastern time, 10:30 my time, then you see how we really started to dive. And it was discretionary, diving from this, it kind of peaked actually on 11:30, an hour later. But technology and communication services, they all just dropped sharply. Real estate also dropping too, but mainly S&P. And we'll talk about the real estate here with our trade idea. And you can see what held up. Financials, industrials, healthcare, materials, and energy for the most part until the end of the day. Utilities and staples also kind of holding up too. So you can see again, it's you had a down day. Now this, sometimes we've been getting performances. In fact, if you go back to that 3-month chart here, let's go back to that 3-month chart right here, and you say, okay, well, from this period, from May 13th, from that low up to that high point, May 13th to June the 8th, if you've noticed, that was a period where the markets were bullish. So May 13th here to June the 8th over here, That was a bullish period for the markets, and you see that the biggest winners were energy, financials, and industrials, and real estate materials. You can see just the technology and communication services lagging, but they were up. So this was on an up day for these trash sectors to lead the way. It's another thing to have it as what happened here today, where everything was down, and they outperformed, but it was on a down day where these tech sector areas, QQQ type names, all led the way to the downside. That's been a lot more uncommon lately. So we'll see if that trend persists. Again, just going from a 1-year chart, just to kind of give you an idea of how, again, we've had this 30% drop in 4 weeks, right in the middle, right in the middle of this 1-year chart, but the market's up for the year, and technology is up 30% for the year, as if, and you have discretionary and communication services, even with this little drop, still up around 10%, and everything else is down on the year. Industrials is down, financials is down, energy is down 45%, real estate, utilities are both down. Those are previous winners. Staples is down. That was a previous winner. So again, goes to show that a lot of this gain that we have in the market, which is to the tune of only 4% on a 1-year basis, is coming from a very small selection of names. And that doesn't necessarily mean, okay, the market's going to sell off tomorrow, like today. Today's just the beginning. No, it just means that we know what the leadership is. And we've seen this leadership lead before, and to the tune of like months of really strong performances. So it doesn't necessarily mean the market has to tank. But, the top 5 stocks are a much bigger percentage of the S&P than what they were in 99 and 2000. 25 versus 20% numbers I saw earlier today. So we are getting pretty extended. So I don't know if we'll have 18 months like we did in 1999. We don't have a seminal period like Y2K, right? Because that's what was pulling forward a lot of the spending. It was January 1st, and once we got to January 1st, and we didn't need to pull forward any more spending, and the markets dropped from there. We don't necessarily have a fixed date and time now. Now it's just a matter of when this vaccine gets produced and the world can go back to normal. That will stop pulling forward a lot of the spending that we're pulling forward to build out this work from home situation, which includes cloud computing and 5G names and networking names, all sorts of things that will build out this kind of a revolution. Like in 99 it was an internet revolution. It was a connect the world revolution. This time it's a be able to work from anywhere revolution. And we don't have to live and spend bazillions of dollars to live in downtown San Francisco in order to have a good job. You can work from anywhere and have the same job. And that's what I think we're pulling forward now. And there's a benefit to society and it's intriguing to a lot of people. So I don't think it's over with. But I do think that once this vaccine gets developed, any kind of vaccine gets developed, and we get pushed forward, it doesn't necessarily mean the market's going to drop. It just means that we'll stop pulling forward a lot of that. And for Y2K, it took a few more months. The NASDAQ peaked in March of 2000. The S&P peaked like in September, October of 2000. So, that's kind of what we're looking at. And that could be, vaccine at best case scenarios by the end of the year, if not into next year. So again, kind of gives you an idea of how much longer this type of leadership and moves can last. All right, for our trade idea of the day, I want to take a look at a stock in this home building sector. We'll look at Toll Brothers. And you notice Toll Brothers has been very bullish, and then it's just been grinding. And it got a yellow line, light pink shading pattern. It bounced off of it for about a week or so, but then it's been kind of flirting up and down with light green shading, dark pink shading, light green shading, dark pink shading. And now it's not only got the dark pink shading, but also has a red line. So very kind of beginnings of a bearish pattern, especially with the intermediate lines, again, still below its market sentiment line and working its way down. If you take a look at the 3 green arrow chart for tolls, you can see the stochastics is turning down towards its moving average. The MACD histogram turned down and close to crossing below 0 and the moving average. The price itself crossed easily below its 8 and 17-day moving averages, which are both still below the 30-day simple moving average. you take a look at its Bollinger Bands, and you'll notice that we are in the lower chunk of the value area, well below the point of control, and to a point where if we break below this node, there's not a whole lot of volume support at all down below us. You take a look at the DMI too, and what stands out here is that positive index. The negative index has been below 20 this whole time, and it has room to run. But when it gets up quick here from these low levels. But the positive index, when it gets below 20, it can be down for a while. Now here it kind of flirted around. The ADX dropped all the way to 10, and really we didn't go anywhere for the longest period of time. Obviously volatility is much higher now from a market perspective than it was back then, and so with a positive index dropping below 20, you can expect that we could get a jump up higher here in the negative index and start working our way up. If you take a look at the RSI and the CCI, you can see how they were never really able to get going. The RSI never got above 60. It's working its way down. The CCI flirted with getting above positive 100, wasn't able to really stay and never get above positive 200 like it did here at the beginning, during this bullish rally. So it's not able to really kind of get going here. You see from a Ichimoku cloud, the red line is crossed below the price. The price is crossed below this green line here. They have their Japanese names. I just will probably butcher the pronunciation of them. We are above the cloud, but you see how easy it's going to be for us to get through the cloud, especially with a lack of a bullish trend going here. So we're set up for, especially with earnings coming up in August, we're set up for some bearishness, some bearish potential here going forward. And so let's take a look at selling or buying a put option. We're going to sell a put option to offset the cost. We're going to buy an out of the money put option, keep our costs really low to begin with, and then we'll sell this 27 put option to offset the cost. So it also caps the gains, but it gives us a pretty decent maximum. Here, let me get rid of this. Pretty decent max reward for a maximum loss of 2-to-1, which suggests that there's a pretty high probability that we can get a this can move down and get to that 27 level. In fact, if it gets to the 27 level, there's a pretty good chance it gets well beyond the 27 level. There's 27 right in there, and as you saw, very little volume support to the downside. So it's a relatively high probability way directional trade, right? And usually when we're doing a speculative directional trade, we're getting about 3, 4, 5-to-1 reward to risk ratios. This one's a 2-to-1, and it kind of makes sense not to be too aggressive to the downside with bearishness when we're so strongly bullish from a market perspective. So in this case, it gives me a 2-to-1, right? And obviously gives me a very easy way to take even less than that. 450 is a half my normal position, smaller than half my normal position. And again, if we bounce up and get back above the 8-day and we just bounce back up, you see how easy it will be to lose only a couple $100, which now we're looking at about a 4 or 5-to-1 reward to risk ratio if we can get out with a few $100. So it's a high probability trade in terms of directional trades, relatively speaking, of course, because of the reward to risk ratio, and that's the type of bearish directional trade you want to make right now, because you get too aggressive with your bearish trades in a bullish market, and you're just saying, okay, here's my money and take it. I'll just go ahead but we want the negative deltas. That helps us in case the markets do turn over, and we want to do it in a way that even if the markets stay bullish, this stock might not. And if once this max gain gets outside of this range, then that will also be a signal to take a small loss. At worst, half what I normally would risk on a trade. So, and also takes advantage of any weakness that we're getting in that housing sector, relatively speaking, again, compared to say like the tech sector, which has been such a strong area. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link right there popping out in the top right corner of your screen. That opens up a thread. That takes you to our Market Outlook forums where you can open up a thread with any questions or comments you have. Reply to other people's threads, and let's keep this conversation going in between videos here. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content between the videos, and join our community at marketscholars.com, as well as our Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all next time.